Welcome to today's webcast, The CFO Playbook on Reporting, a changing picture of performance, brought to you by CFO Publishing, a division of Argyle, and our sponsor, Workday. I'm Jess Bazzo, and I'll be your MC. Now, I'd like to welcome today's featured panelists. We'll start with Roger Howell, Principal at PwC. Roger is with PwC's Strategy and Operations practice, focused on strategy and operations, as well as enterprise profitability. Applying more than 24 years of experience with business model and operational model innovation, he has helped organizations with enterprise profitability, operations, quality systems design, and implementation. Next, we have Steve Elliott, Director with the Hackett Group. Mr. Elliott has designed and implemented EPM solutions for companies in a wide range of industries, including consumer goods, retail, banking, business services, telecommunications, technology, hospitality, and healthcare. Among his areas of expertise are FP&A transformation, planning, reporting, EPM technology design and implementation, organizational design, deployment and change management, strategic cost management, and merger integration. Last but not least, I'd like to welcome today's moderator, Joe Fleischer, Editorial Director, Custom Content and Research with CFO Publishing. In his role as Editorial Director of CFO's Publishing's Custom Content team, Joe focuses on developing ebooks, research reports, and virtual events on topics that reflect the primary concerns and priorities of senior finance executives. Welcome, Joe. Over to you.
Well, thank you very much, Jess. Thank you, Roger and Steve, and I thank our audience. And let's get started. We want to pose our very first question to panelists. Our very first question, which I'm going to direct first to Stephen of the Hackett Group and then Roger of PwC, is, starting with Steve, what are the most significant developments in financial reporting that CFOs need to know about, and what's new?
Yes, thanks, Joe. Information is readily available to everyone, everywhere, all the time now, and that's really one of the major changes that we've seen over the past 5 or 10 years. The expectation and pressure is on finance organizations and CFOs to be able to access that information, to have it at their fingertips, and to be able to provide financial updates quickly and as needed to various stakeholders. I think, from a perspective of reporting structure, if your reporting systems and processes are disjointed or manually intensive, for example, there's no common chart of accounts or governance is lacking, it makes it difficult to respond and be competitive in the market or to really support fast decision making to the degree that customers require it. For example, for a client of mine in healthcare, with a lot of a role of strategy and a lot of acquisitions, they had a number of integration opportunities that were never completed, and as a result, they had difficulty being nimble with reporting because the lack of integration made it difficult to roll and change accounts and structures, reporting structures very quickly. With the business models and business environments constantly changing, it's important to design and build a flexible reporting platform that can scale with change, and that requires an integrated data model and chart of accounts that ensure a tie between the transactional and reporting reviews. And governance is important too, to accelerate and be able to manage changes across that structure.
Well, thank you very much, Steve. Roger, with regard to reporting emerging as a competitive differentiator and other aspects of reporting, what would you add to our discussion?
Well, there's a few things. I think it's important to understand the compliance-oriented reporting, and then there's the analyst and other stakeholder type of reporting. And clearly on the compliance side, many businesses are investing heavily in shared service centers, best-in-class software, automation, not even best-in-class software, just automating it to make it fast, take the errors out, take the cost out, but still be very high quality. And I think that's an important point, is that focus on quality improvement. The regulators are focusing on it, and therefore companies have to focus on it, and it's something you have to be ahead of. You don't want to be that person on the newspaper article. The other one is really getting more information around the business model into the reports for analysts, for the management team, for business partners. Being able to effectively describe your business model beyond core financials, potentially having some non-financial measures on quality or operations performance or customer acquisitions, things like that provide some insights is becoming more and more important. Many businesses are finding that a number of factors make up their share price, and being able to talk to that and have that in a crisp fashion is becoming increasingly important. All right, back to you, Joe.
Thank you very much, Roger. And I think what we're now going to do is turn it over to Jess. I think we have our first polling question.
Great. Thanks so much, Joe. Our first polling question asks the audience to please indicate the extent to which you agree with the following statement. My finance team has the information my organization needs to have a clear understanding of its performance. The options are strongly agree, disagree, strongly disagree, or I don't know. Please take a few moments to select your answer. As a reminder for those attendees seeking credit for today's webcast, you will need to answer all 3 polling questions. I will leave this question up for a few more seconds to allow the remainder of the attendees to answer, and once I shut this question down, we will share the results and have Joe make a comment or 2. So please go ahead and make your final selection. And Joe, here are the results.
Well, thank you very much, Jess. And I do want to acknowledge it's very encouraging that there is apparently fervent agreement among our audience, large majority. That said, there is a significant percentage who disagree, more than 10%. So for those who are joining us who are not necessarily convinced your finance team has the information your organization needs to have a clear understanding of performance, we thank you for joining us. And actually, we can now pose our second of our questions for panelists. Our second question, which I would like to direct initially to Roger, asks how are changing expectations among investors, we talked about investors, and other stakeholders affecting the nature of reporting. Roger, we'll start with you.
Well, Joe, thank you. And that was an interesting response. It was agree, but not strongly. And I think the important point is there are changing expectations. Clearly, investors want to have a good discussion. There's been a lot of input around GAAP and non-GAAP lately, and what's the right thing to look at. Non-GAAP has received some criticism recently for how those things are being reported in some circles. But the investor community in particular and partner stakeholders, whether they're customers or suppliers, are often very interested in the operational performance and how things come back to shareholder value. Clearly, in the last 4 or 5 years, we've also seen the rise of activist investors that are putting a lot of pressure on management teams, not necessarily taking over, but investing, pressuring, and if they don't see progress, starting to move in. So being able to, naturally meet the increasing compliance requirements is important, but being able to describe your business in a meaningful way, providing lines of sight into, business segments or trends. If you're in the tech industry and you've been working in hardware, but you're adding software, how's your software and services business doing, right? If you're in one of the big insurance companies and you had a managed care and other business models, how those different segments performing for you? How does that tie back to your capital structure? These are all things that are becoming increasingly important, and getting that kind of visibility to excite investors and also more importantly with the activists, let them know that you've got control and a good insight into your business. Those are very important things. Steve, you've got a few comments too.
Sure. I would add to that with the advent of social media, we're looking at monitoring and managing the company's reputation or other things using big data and analytics. So there are other data sets and sources out there that finance organizations are trying to make sense of. Unstructured data, such as social media, needs to be analyzed and turned into information that could be used to quickly support decision making. I think from the perspective of skills in the finance organizations, there have also been significant changes in that finance has taken on and continues to evolve to take on more strategic responsibilities. So it requires resources in finance with the ability to navigate between analytical, technical areas and have the skills needed to interact with business partners, people who want to be involved with and learn the business rather than just crunch numbers and do the accounting. And last thing I would add to that is, the importance of strategic planning and forecasting process with the external reporting constituents in terms of providing guidance to the street around a company's strategic direction. So we have, examples where pharma clients, for example, need to be able to support the strategic planning process and their audit requirements around intangibles and goodwill impairments. I've got a CPG client, for example, who has a strong brand orientation and talks a lot about in their filings about their brand. So there needs to be the ability to integrate the strategic focus areas with the reporting and data to support that. So, and it needs to be, something that's done consistently from time to time, for example, with investor calls. So there are a lot of changes in terms of, investors and the expectations of stakeholders that are changing the way that FP&A organizations and finance organizations do business.
Well, thank you, Steve and Roger. Steve, continuing with regard to these ongoing changes, as a result of these changes, what would you characterize, Steve, as the most pressing issues finance teams are encountering with reporting, number one, and then how can CFOs overcome these issues? Steve, why don't we start with you, and then Roger, we'd love your perspective as well.
Yeah, sure. There are, Joe. There are a number of issues with, the changes and the issues that finance teams are encountering with reporting. I think with, obviously with the changes in standards over time, the requiring changes in adapting business practices to support and be able to support the, the changes in accounting requirements like revenue recognition. That's ongoing. But we've also seen, in terms of the shifts in business strategy based on either leadership changes or evolution to the business or competitive environment, that sometimes legacy practices survive past their useful life and are less relevant to the business than they once were. So they no longer support the needs of the business, which means that it's sometimes time to address improvement opportunities, with evolving the reporting capabilities of the firm and changing the data sets that are used and how information is generated to support decision making. Another thing is the cost of implementing the changes. I think that obviously for anybody on this call, you're going to look at significant changes to systems or processes or procedures or even upskilling in the organization and training has an impact beyond finance into other functional areas like marketing. For example, you're going to see a lot more change management requirements and costly projects required to change it. Getting the data model right is another big change. I mentioned before the example of acquisitions and a roll-up strategy in one of my clients. It's a complicated process, and oftentimes the can gets kicked down the road in terms of the timing around when those organizations are brought into the fold. Sometimes that requires a lot of Excel work to knit them back into the reporting process and create some issues as the business model changes. And then I would just add, in terms of other types of reporting, so when we start to, I mentioned the brand example before, when you start to look at things like dimensional profitability, brand reporting, customer reporting, for many organizations, these are things that are front and center for investors as well as the management teams. And again, there needs to be a consistent story and consistent use of data from period to period to report on those as well. So I think in terms of the CFO challenges, they're really in getting in front of those types of issues, creating the data structure and the reporting structure and supporting technology in order to be able to do a credible job reporting against those types of issues.
Thank you very much, Steve. Roger, I know we've, in preparation for our webcast, you've thought about distinguishing financial from other types of reporting. What thoughts do you have in this area?
Well, I think, a couple points. One is, a lot of the financial reporting is around compliance and, being aware of the rules and the changing rules are critically important. I think for those companies that are in North America, depending where you're at, revenue recognition rules have been evolving and usually continue to. But this is a period over the next few years, especially if you're in a services business, where some of that is going to change significantly. If you're international, the focus on tax, right, with the BEPS, the base erosion and profit sharing focus is something that companies have to get a lot more disciplined and a better understanding of. And then some of the things around intercompany banking, right, where if you're overseas and have units that are funding each other, new requirements and reporting around that. They involve technology, they involve outputs to the regulators, and so it's critically important to stay in touch with that. And then also clearly, if you're in deals, understanding the different regulatory bodies that you're dealing with and being compliant for those, especially if you're working cross-border at all, can be quite complex. It's not just a data exercise with smart people in your own organization with the data from your business, but oftentimes it's really understanding externally what the rules are, and they continue to change, and how do you build that into your organization to attain that understanding. At the same time, finance is being looked at to do more than that, and that's a big job all by itself right there. But the management reporting piece, finance is increasingly being looked at as the source of the truth to bless reports, and whether they're financial or they're operational. Clearly the internal audit role for financial reporting is important. It's becoming increasingly important to validate, project plans and transformation plans. Are the customer metrics, the supply chain metrics, the R&D metrics for performance good? Not that it all rests with finance, but being able to, in essence, get the business model down for management reporting and have it tie back to financials in a really meaningful way is becoming increasingly important. So finance has those dual roles where they need to keep up with the trends and then also get much smarter about and frame the operating model in the financial reports. It often necessitates having not several sets of books, but different outcomes, right? It's a different outcome for annual reports, for tax reports, for other regulatory items, and then you may have some different views to cut product and customer profitability segmentation for finance, so and the other executives. And so, being a whiz at setting up the data model and getting a bunch of different views off of it is becoming increasingly important. Joe, back to you.
Oh, thank you very much, Roger. And we're going to explore this further, moving beyond compliance. Now, what we're going to do now is pose, essentially, it's a three-part question. We're going to start with you, Stephen, and I'm going to give you, Stephen, the opportunity to cover two aspects of this initially, and then Roger will turn it back to you. But what we want to start off with, again, Steve, is first, what strategies finance teams can use to speed the financial close process. Then we'll talk about tools in general or advances in technology in general, Steve, and then Roger will turn it back to you to continue this discussion. But I'd like to start off, Steve, first with what strategies finance teams can use to speed the financial close process.
So when I think about this, I think about it from three perspectives. I think about it from a process perspective, and then from a people or from an organizational perspective, and then from a supporting technology perspective to enable the capability. In terms of process to speed the financial close process, obviously there are opportunities in most organizations to streamline the close cycle, to pull things up sooner in the process, to make sure that we get visibility and predictability in the financial consolidation and close, and then to make sure that the financial controls required to ensure the accuracy of financial results are integrated. From that perspective, there's an opportunity to address external or statutory and internal reporting needs, but also address the organizational implications around governance roles and responsibilities for process sourcing. I think from a cost management perspective regarding financial reporting and filing, you're looking at simplification and standardization of policies and data, automation of journal entries and reconciliations, is another opportunity, and the ability to make sure that we're not leaving too much for the close process and getting ahead of the game to the extent possible. From an org perspective, we're looking at shifting talent away from transactional work into shared service centers or other organization opportunities where you can have folks who are focused on close and focused on process excellence, driving some of the changes. So there are always opportunities to extend and expand shared service capabilities with regard to close beyond the transitional processing that traditionally has been the focus, but instead moving to more of a closed center of excellence, which would include overall reporting. So you'd have, for example, activities that were typically done in FP&A organizations, which could be centralized and made as part of the shared service operation or center of excellence operation for reporting. And then finally, from a tools perspective, tools have evolved to align metadata changes, for example, entities across systems, but there's a significant focus on embedding controls and validations within the financial consolidation and reporting book of record. So there are opportunities to make sure that tools are put in place to manage account reconciliations, to look at disclosures, and make sure that there's automated cash flow reporting. I think Roger mentioned a couple examples earlier of tools providing support to the process and being able to automate some of the routine recurring stuff. And we need to make sure that from the perspective of technology, that it's not a quick fix. It's better to look at the entire technological architecture to determine what the optimal financial reporting tools and solution set will be. But there are a lot of opportunities to accelerate the process and support it through automation and technology.
Thank you very much, Steve. Roger, I know there's been a lot of discussion recently, especially about robotic processes. What aspects of automation are you observing that are becoming particularly significant with regard to reporting?
Well, coming back to Steve, the point you made, it's some of this isn't a quick fix. As you get into sort of ERP and that big best-in-class software, they're huge programs. And so, while the aspiration is always to improve the process and get to best-in-class software and automation, it's not always economically viable, nor is it quick. And so, these two tools here are something that companies are focusing on that it is quicker, and they do have a good return on investment. The first one is robotic process automation. Kind of a bad name, but it's the name that's stuck in the industry, which is basically automating what you already do, whether it's a best-in-class process or it's a fast process. The fact that you can automate it usually takes cycle time out. It takes errors out, human error, and you might not be doing the three-way match on an invoice, for example, that you would like to do. But the fact that you've got it automated and the swivel chair key entry isn't happening are huge benefits. The other thing is the process automation has workflow in it, right? So you can put in some of the controls. You can get some audit trail along how information's flowing and really start to have some assurance that the segregations of duties are there, that the quality from step to step is there. You can see where bottlenecks are. It's a really nice way to automate. Now, in the United States, banking's been on a leading edge of this, and they've had big cost reductions in certain areas of 70–80% by process. Another tool which many businesses use are service delivery centers. And, especially multi-product or multi-regional businesses will have different IT environments. Not everybody's on the same ERP. And just being able to consolidate the processing, whether they're on different ERPs or on the same, and having the finance team, do payables and invoice, and then all the reporting, just provides a lot of benefit. It gives a common management. It consolidates the problem, if it's an IT problem, into a single place where somebody can address it, where versus in some other businesses where it might be disparate, and gets good management oversight on it and starts to focus on key transactional metrics. So we see these two trends coming in, not just for reporting, but more broadly in finance, but it really helps speed up the end process with the data management and a team that's at scale. And many businesses will have service delivery centers in a few regions. Some will concentrate it. So there's some choices on how to do. But these two areas, in essence, they compete with each other. The robotic process automation is doing a flow through IT, and the service delivery centers are taking that and consolidating that work to a group of people used together. Right. That's where the most benefits and speed usually happen. So Joe, back to you.
Thank you very much, Roger. This leads us actually into best practices, and in particular, there's the overarching question, which I'm going to direct actually first to Steve and then once again to you, Roger. But essentially what we want to pose is a question about how much attention the CFO should pay to ensuring that a company's financial reporting practices keep up with the times. And then what we want to do, once again starting with you, Steve, is explore these best practices.
Sure. Thanks, Joe. The role of the CFO in ensuring the financial reporting practices is absolutely vital. The time spent depends on the company's current technology footprint and process maturity. But in essence, CFO is driving a number of things that will make sure that the financial reporting processes keep up with the times. First of all, for leading practices, we're looking at things like a common general ledger on a single platform integrated with subsystems in a data warehouse. You're seeing things like standardized charts of accounts, utilizing company-wide information coupled with common data definitions. Let's see, use of a thin ledger containing summary-level financial information supported by integrated subsystems as opposed to full ledger. And shared services, or looking, as we just discussed, outsourcing providers to perform general ledger activities is another thing that CFOs are focused on. We're looking at the standardization and enforcement of materiality thresholds for reporting. So, what's worth digging into, and the what are the cutoff levels for materiality, and then looking at a consistent published close calendar with enforced cutoff dates for transaction processing, and finally looking at cost allocations minimized and automated where possible, and basically those allocations recorded based on budget numbers and reconciled quarterly or annually as opposed to monthly. So it's really looking for, from a process perspective in each one of those areas, an opportunity to automate or to make processes more consistent. And then, from a governance perspective or from a COE perspective, you're looking at, making sure that there is control over that process and a decision body in place to drive global standards, and make sure that there's a clear linkage between those standards and the what the business executives are looking for information. So that's part of coming up with a set of clear and concise requirements for monthly reporting, keeping it simple, less is more in a lot of situations, and then looking for ways to remove manual efforts and complexities from the process.
Thank you very much, Steve. And Roger, what best practices are you observing, and what's the CFO's role in making sure that organizations maintain and sustain them?
Well, Steve, you were talking a lot about keeping it simple, and I've been in many clients where you'll find them with 1,000 or 2,000 or 3,000 reports that they generate monthly, and that just can't possibly be reasonable for the business. Ad hoc reports seeming to become more permanent ones, and it creates a lot of workload. I think in that regard, the responsibility of the CFO and the finance organizations really to help get the business model down and start to get some good cascaded reporting, primarily around management reporting. And what are the level 1 scorecards by function? What are the level 2s and 3s, and how do they drill down? The level 3s might be temporary, where you can solve a problem, and then once you're solved, it turns off. So finance isn't constantly generating information. In terms of the public reporting, certainly developing standards, getting them consistent across the business, and if you have multiple ERPs, trying to take the way things are done consistently back into those is quite important. And that's a place where a shared service center can really help. If you distribute standards out to 30 or 40 or 100 different sites, they'll get implemented locally, and then finance on the back end has to reconcile in a substantial way. If you can consolidate some of that to a location or a few locations, they can get a lot more consistent with that, make the organization faster, but more importantly, that information going out to your government organizations that you're dealing with is going to be much higher quality. You're going to have a lot more confidence in it. Joe, back to you.
Well, thank you very much, Roger. We've been talking a lot about distinguishing financial from management reporting, and related to that, and Roger, I want to initially pose this question to you, is what types of non-traditional or, say, metrics not typically associated with generally accepted accounting principles are companies including in financial reports, and does doing so add significant value? Roger, why don't we start with you?
Yeah, I think I commented earlier, some of the non-GAAP metrics have come under a little bit of criticism lately in certain circles that look at financial reporting. And partly the criticism on non-GAAP has been that it's sort of reshaping the financials. The financials in many businesses, when you go to GAAP, they mean something. When you go non-GAAP, now you've got to read into it. And people and companies have been spinning some different views on that. Some make sense, some don't. So I think when you're really looking at the financials, it's important to come back, back to something that makes sense. I was talking with a CFO once, and we were talking about his operating profit, and he was mentioning a different number than I had in my head. I was looking at the GAAP numbers. He was looking at something else. And it just helps you come back to, when you stick with GAAP around the financials, how it's really being viewed by the market. Where it's important to start to look at non-GAAP measures are things where you're starting to reflect the operating performance. If you're in an annual report, clearly you can start to talk about some things beyond the GAAP reporting that reflect the essence of your business. Providing insights into customer supply chain performance or R&D performance can really get investors excited. They can get your customers excited. If you're a supplier to a company, they're looking at these statements now to see the quality of the relationships they have, and it becomes increasingly important as a tool where you represent your business in the marketplace. Also important are things, social measures in terms of how you're having an impact on society. There's certainly some talk around improving reporting to start to reflect that. There's some new corporate forms, in fact, that are advancing some of that. But starting to bring some of that into your business view where it's important shows how you're affecting the world beyond the financials. And that's become increasingly important in some of the investor community. So understanding those different metrics, what market you're in, and how it shows up against the competition is becoming increasingly important. Steve, you've got some comments too.
Sure. Yeah, agree 100%. And I think from a integration perspective in terms of GAAP measures versus some of the operational measures that you referenced, Roger, you're looking at a combination of two sets of information that becomes a powerful analytical tool in understanding what's going on in the underlying business, and which are very complementary to one another. So if you think about industries where your non-GAAP measures are critical drivers for performance, like in hospitality, you're looking at, for example, revenue per available room, and airlines might be looking at utilization of seat miles. You could be, for a CPG company, looking at the relative performance of brands. But those are the types of complementary information that are critical to integrate with the GAAP information to tell a more complete story and provide insight into how management views its performance. It's also stuff that investors are going to be calculating on their own if you don't provide it. So it's, it's important to take control of the narrative sometime and make sure that the information being provided on an investor call, for example, is relevant and consistent from period to period. So that requires some work in terms of the underlying data and the structure of the information and how it's reported. So there's a, at the end of the day, a clear and transparent disclosure of, what's included or excluded from that dialogue, but importantly, a view into operating performance that jives with the financial performance that's typically shared.
Thank you very much, Steve. And I'd like to follow up on what you've said, and I'm just going to pose this question to you to elaborate on what we've just discussed. Specifically, once again, Steve, what essential aspects of performance does financial reporting or traditional financial reporting leave out?
Yeah, I'm glad you clarified, Joe. It's more traditional financial reporting. It has a retrospective orientation, so you're looking at essentially what has happened in a prior period with some narrative around why. I think from a, in terms of the forward-looking view, it's really getting your arms around the drivers of the business and giving some insight into how the actions and strategies of an organization will translate into future period outcomes. So when you think about valuation of a company and current value versus future value, there's got to be that credible linkage between what the strategy of the organization is and the investment community's, in this case, belief as to what's going to be the outcome of that strategy and the likelihood of management's ability to execute against it. So it's really, as you start to peel back the onion and start looking at business unit performance, start looking at brand or even, different business models for a diversified company, being able to understand what those drivers are, being able to look at things like capital, liquidity management, risk management type issues, as well as business unit performance, and in cases, predictive analytics to really get a story told that holds water in terms of what has happened and also what's likely to happen in future periods.
Thank you very much, Steve. I'd like to turn it over now to you, Roger. We've talked about, operational performance and finance teams increasingly reporting on that. That said, in order to do so, in order to get a full, clear picture of performance, finance teams need to work best with other areas of an organization. For the many organizations, though, the challenge is how do they do so? So starting with you, Roger, and then Steve, how can a finance team work best with other areas to develop a clearer picture of performance?
Well, thank you, Joe. I think on a few previous webcasts, we've talked on planning, we've talked about forecasting. I think one of the things that we talked about on both of those and this one here too will be really figuring out what the indicators are and working with the rest of the management team to get the business model down on paper, if you will, or get the metrics set. And so it's very important for the CFO organization to come and define the performance indicators, start to tie those back to how they influence financial performance of the business. Some things can't be done 100%, but to have a good perspective on that. And then really work within the organization on how it's going to improve. Do we have external benchmarks? Finance is often the arbiter of, is it true, right? But also increasingly becoming the arbiter of, is it good, right? And are we at a good level? Is our target effective? And so being able to talk about that with some authority is important, which increasingly pulls finance into doing and supporting some external benchmarking. And if operations is reviewing competitive supply chain data, how does finance play and validate that? Getting that down into a vision around how that's going to impact the financials. If we, improve our customer delivery, what should that do for us? Will it increase sales? Will it increase profitability? How's that going to affect working capital? We want to understand these things, at least have a perspective on that. And then getting out the requirements to the business. What does it mean from a reporting standpoint? What forums are we going to address these in? And so, we're increasingly seeing the finance organization not just say, hey, here's the GAAP numbers we have to produce, we have to deliver these reports, but they're starting to work with the business over the course of the year to define important measures and set targets around where they're going to drive and tie, capital investment, tie headcount investment, operating expenses to that. And then when things come off trend, right, being able to, pull that up for the management team, as early as possible through dashboards and scorecards and those types of tools through, ad hoc reporting where you need to dive into an issue area. And of course, the compliance responsibilities are being looked at, but this tends to become more of a management reporting and early indicator approach. Steve, maybe you can expand on a few of those points.
Sure. Yeah, that's very well said, and I agree completely. I think from when I look at the question, I also think about turning the lens inward and focusing on the performance of the finance organization. So I start to think about things like, where does the finance organization stand against benchmarks and best practices? How are we doing as an organization? There's unrelenting pressure on finance to do more with less, to upskill in terms of our capabilities, but also to add more to the bottom line over time, or to at least hold the line steady on cost. In terms of being able to articulate the future state vision for the finance organization and how it supports the rest of the organization, from an information perspective is critical. I would add that, to raise the point that was made earlier, from a housekeeping perspective, Roger brought up the point of report rationalization and the opportunity to, make sure that there's focus in the organization on what's truly relevant, and we're not churning a lot of information in hopes that there's a home for it, or because it was something that was deemed valuable once upon a time. So there's obviously an opportunity, an ongoing opportunity to make sure that the actions that we're taking as a finance organization are linked to making decisions around business investment over time. And then of course the underlying data and information flow challenges that go along with that are critical, in that we're always looking at providing more relevant information and trying to accelerate that speed to decision making cycle. And with the advent of big data and some other areas, there are new opportunities to go out and find new sources of information and provide information that's of relevance to decision makers in the organization.
Well, thank you very much, Steve and Roger. Continuing this particular discussion, I'd like to first direct our audience to our second polling question before we continue our discussion further.
Great. Thanks, Joe. Our second question is, within your organization, how would you characterize the role of the CFO in communicating information about your organization's performance? The options are: the CFO leads, the CFO serves a leading role alongside other executives, the CFO serves as a supporting role, the CFO serves no role, or I don't know. Please take a few moments to select your answer. As a reminder for those attendees seeking credit for today's webcast, you will need to answer all three polling questions. This is the second one. I will leave this poll up for a few more seconds to allow the remainder of the attendees to answer. And like last time, once I shut this question down, we will share the results and have Joe make a few comments. So please go ahead and make your final selection. And Joe, over to you for the results.
Well, thank you very much, Jess. And it is encouraging that at the very least among respondents, we see that CFOs are serving at the very least leading roles, although maybe not necessarily leading. What's interesting, though, is we do see that CFOs serve prominent and important roles. That said, we do now want to explore a question, and I'll direct this initially to you, Steve, and then we'll hear Roger's perspective. Does the CFO's increasing role in performance management have an impact specifically on the nature of financial reporting? And if so, how? Again, Steve, let's start with you.
Sure. First of all, I'm encouraged by the poll results. I don't think the CFO leading out front by themselves is necessarily a good thing. So I was encouraged to see that 2/3 of the respondents were viewing the CFO's role as an integrated partner with the rest of the business leadership team. But to answer the question in terms of the impact on the nature of the financial reporting, yeah, it has evolved to meet the changing needs of users as we've been discussing. For example, the business and capital markets have become more challenging, and and demanding, and investors continue to look for clearer, more concise information about, as we've said, financial and non-financial drivers, and they're looking for a consistent story from period to period. So it's up to a CFO to make sure that the financial reporting is keeping up with those demands. I think the days when the CFO could simply provide a breakdown of line items and look at period-to-period performance across the financial statement are over. I think there's much more of a focus now on providing critical business performance management information so that investors can make informed judgments and improve their own decision making. So when we start to talk about things like the key metrics and performance indicators that investors consider important, we're looking at some of those drivers that we've been discussing. So this is no longer optional. I think I mentioned earlier that this is something that the organization needs to control and be able to share real time, or investors will make and model their own assumptions. So it's to me part of taking control of the narrative and making sure that the management team is able to tell a compelling story and build on that story from period to period in a way that is traceable and credible.
Thank you very much, Steve. Roger, I'd love an elaboration regarding our third bullet, regarding the role of the CFO emerging as the source of truth. What are your thoughts in that regard?
Well, I think we just see that internally and obviously externally. That's always been there. But I think it comes down to, if we're looking at certifying the revenue, the profit, or how the company's financed, clearly the CFO needs to talk to the accurate representation of that. But talking about the drivers, I think that's something that can certainly and does influence the share price of a company. We'll see, and we start to break apart companies in terms of their their revenue growth, their profit expansion, the leverage, M&A activity, all things you can model quite well, right? And it's rather mechanical. And in many stock prices, you'll find that there's a value difference when you do the math the way that you normally should. And a lot of that comes back to the narrative of the management team, which comes down to, do you have a good strategy, right? That's the first question. And then secondly, are you showing the operational measures that tie to that? And can you have a credible story around that? Some companies, share a little bit more than others. But most importantly, being able to pressure test that with analysts, with sometimes activist investors when you need to, and being able to demonstrate how those things come back is critically important. And if you're the finance organization and you're going to start to get into doing that, whether it's internal for management reporting or external, because you'd find that helpful with the marketplace, you have to know the numbers are right when you're in finance. And that's a place that CFOs are really getting invested in, is getting them defined and then ensuring that the data is coming in a quick way and that it's accurate. And so that's a big part of the investment around getting into new KPIs and dashboards and the like. And finance's role, just to make sure it's credible, is becoming increasingly important. Joe, back to you.
Thank you very much, Roger. Well, I've enjoyed our discussion. Before we address great questions we've received from attendees, before we also pose our third polling question, we want to pose our last question for panelists, starting with Steve and then Roger. Steve, what are the most important points you would want webcast attendees to keep in mind after our discussion about performance?
I think from my perspective, simply put, have a reporting strategy, right? Make sure that from a reporting perspective, there is a future state vision for how performance reporting needs will be met within the supporting systems and tools. And oftentimes it's important to have ownership for that reporting strategy reside with a global process owner or somebody in the organization reporting to the CFO who can be able and have the authority to make decisions and guide that reporting strategy. So part of that would be making sure that the organization is benchmarking or looking at their efficiency and effectiveness in reporting. Looking at based on the results of that benchmarking, what projects or initiatives are required to get to the future state and how they should be prioritized. and then making sure that, as we've mentioned a couple of times, that the work to clean up the organization, to integrate where possible, to develop the coherent and logical data model that is required to do reporting across the enterprise is in place, and make sure that the information requirements and needs of the reporting strategy are being met. So it's all those things need to come together in a coherent reporting strategy with a roadmap to get to where the organization wants to be over time.
Thank you very much, Steve. Roger, we talked initially about moving beyond compliance. Now that we've come full circle, what would you want attendees to come away with?
Well, a lot of compliances is the number correct, and I think the second bullet here is becoming increasingly important, which is, are we efficient and effective? Particularly when you look at your cost structure, whether it's SG&A or the G&A, it's finance and HR and IT, are we spending money and getting a good return? Whether it's R&D or supply chain or sales and marketing, are we getting a good return? Being able to talk to that is becoming increasingly important, just how much are we spending on that. And that's where competitive benchmarking, some bottom-up, zero-based budgeting kind of activities can help on the front end. And then on the back end, when reporting, you need to reflect it in the measures to make sure the results are showing up. So this conversation we had about picking effective KPIs that are meaningful for your business is becoming increasingly important. And that's often a role that the CFO shares with other executives. If you're going to look at the supply chain, for example, clearly working capital is going to be a measure. Clearly material spend and conversion spend and overheads are going to be an issue. But what are the things that actually drive that? Having a good agreement with your peer in operations is going to be critically important, and other functions. And so, that's going to be a portion of the activity. The other piece is starting to bring a little more sophisticated operational perspective. This might not be something that benchmarking can supply. Do I want to have a good customer response time? Should I drive a little bit more inventory, right? Inventory is not bad if it gets you an advantage and you actually do sell it, right? And so having some understanding around distribution facilities, being closer to the customer with a little more inventory can provide a market edge is important. And so being involved in the conversation that way, understanding what the targets are relative to that, that's something we see coming in. And then, making sure it shows up into the scorecards. In essence, it's translating the strategy into how the business is being measured, so that we can make sure the financials are going to show up. And the more early indicators the finance organization can bless as a true data point, that's definitely something we see as a strong trend here. Joe, back to you.
Thank you very much, Roger, and thank you very much, Steve. Before we address great questions we've received from attendees, I want to turn it over to my colleague Jess to pose our third polling question.
Excellent. Thanks so much, Joe. This is our third and final polling question. The question is, within what time frame, if any, does your organization plan to improve the efficiency of your performance reporting processes? The options are, we've already done so, within the next 6 months, within the next 12 months, within more than 12 months, we have no plans, or I don't know. Again, please take a few moments to select your answer. As a reminder for those attendees seeking credit for today's webcast, you will need to answer all 3 polling questions. This is the last one. I'll leave this poll up for a few more seconds to allow the remainder of the attendees to answer. And like last time, once I shut this question down, we will share the results and have Joe make a few comments before moving to Q&A. So please go ahead and make your final selection. And Joe, here are the results.
Well, thank you very much, Jess. Well, this is intriguing. It is encouraging that a plurality have indicated that time frame for improving efficiency of performance reporting processes goal among attendees who have responded to this question have indicated within the next 12 months. That's very encouraging. And actually, this segues nicely into some great questions that we've received from attendees. And, I want to follow up on something that, Roger, you had mentioned having to do with scorecards, and then, Steve, I'd love your perspective. Do you find, we were talking about this earlier, of course, do you find that organizations, and particularly finance teams, are more open or increasingly using, let's say, options such as benchmarking, scorecarding, to gauge whether or not they are capturing or have a good understanding of their organization's overall performance? Roger, what are you observing?
Well, they have to. and there's some basic benchmarking that comes back into, financially, how are you performing, right? You've got to benchmark your total shareholder return performance, for example, right, in some of your financial statements. And so there are a few requirements to do some peer benchmarking already in the finance, right? So it's coming from certain governments around the world in some areas. So the question is, how much further do you go than that? And clearly we're seeing more of that coming. This conversation around, are we adding shareholder value? If you don't benchmark it, for sure the activist investors run models all the time. You have to know if your revenue is the one contributing to your TSR, your revenue growth, your profit, your leverage model, right? Do you have a good mix? And then it takes you to the next question, right, which is, what's driving that? And that's the place where we see finance organizations, one, understanding that model and mix better, but then two, starting to look at those measures. And I'd say the more sophisticated companies are already there in some ways and understanding their operations a lot better. But it's just, it's a requirement, and it's going to keep coming. And by the way, I also want to go back to if you're not changing your reporting, there are regulations coming in the next 12 to 18 months. So if you think you've already done it, you're going to have to come back to it. If it's not on your roadmap, it's something that you really need to take a look at, because it's a constant focus, and it should be something that the management team's looking at, particularly for U.S. companies here on at least a few measures.
Thank you, Roger. Steve, what would you add, and what are you observing in terms of performance reporting in general, particularly with regard to benchmarking and scorecarding, for example?
Yeah, I would agree with Roger's comments in terms of having an external view of your performance vis-a-vis your primary competitors. I think it's, as Roger mentioned, it's something where if you're not doing it, others are doing it for you right now. So it's important to make sure that the metrics, the core metrics in terms of turns, in terms of capital performance, capital-based returns, are being evaluated vis-a-vis the competition, so you can have a sense for what is good and be able to assess strategy and targets in the light of, how are we doing, how's the market doing, our market doing, our industry, and then is our performance meeting expectations? Are we over or underperforming on our industry? And there's a direct link to valuation, based on an organization's ability to do that over time. So agree completely.
Thank you so much. Well, I just want to thank you, Steve and Roger, and our audience. I'm now going to turn it over to my colleague, Jess. Once again, I thank our panelists and our audience for joining us.
Great. Thank you so much, Joe. Again, we'd like to thank today's sponsor, Workday, for making today's webcast possible. You can see some additional information on Workday here for your review. As a reminder, today's slides can be downloaded as a PDF by clicking on the link in the resource list area. If you are eligible to receive CPE credit, you will be able to click on an icon to download the certificate located in the certification section. If you are eligible to receive a certificate but cannot currently download it, this webcast will be available on demand within the webcast section of CFO. When the on-demand webcast is available, you will be able to view and listen to a streaming archive of our webcast, download the slides, and access your CPE certificate. We invite you to complete an online feedback survey. The survey will appear in a separate browser window once we close down the event. As always, we appreciate your feedback. Thank you again to today's speakers, Roger, Steve, and Joe, for an engaging and informative session. And last but not least, thanks to you, our attendees, for joining us today for the CFO Playbook on Reporting, a changing picture of performance. Enjoy the rest of your day, and thank you again for joining us. Thank you again for joining us.